Hey everybody, looks like we've got people from all over the world joining us. So depending on where you are, good evening or good morning. Hope you've had a good day. This is Dan Reecer from the Acala team, and I'm joined here by Bette Chen, one of our co-founders. Yeah, thanks everybody for getting on. We've got a lot to talk about today, and definitely I think a lot of questions on everyone's mind about what's been going on in the market, and also just kind of wanted to spend time to just talk about stablecoins in general. I know this is becoming one of the most talked about topics in crypto right now, and honestly in finance in general. So there's plenty to talk about as far as just the kind of basics and fundamentals of the different types of stablecoins and how they work. And then we'll get into the stablecoin that, of course, we are working on, and Bette and the team have been working on for the past few years, which is Aosd, and get into a little bit more detail about how that works. So yeah, I don't know, Bette, if you want to give a quick introduction to yourself for people who may not have met you before.
Yeah, definitely. So so I'm Bette, one of the co-founders of Acala. And maybe a couple more words for those who are new. We are one of the first teams, well, if not the first team, outside contributor to the Polkadot and Substrate open source GitHub repo. That was back in 3 years back. And then when we started building in the space, we kind of tapped shoulder to actually build a stable coin for Web3, for Polkadot multi-chain ecosystem. So I'll probably share a little bit more detail, how we come up with the model and things like that. But back in the days, when we actually thinking about all of this, you actually think what trade-off you want to make. Back in the days when we actually look at building a decentralized stablecoin for Web3, there are many different mechanisms that then will actually go into today, so everyone have an idea what trade-off you are making by using, holding, or playing with different type of stablecoin. But the one that we chose is certainly in the category of decentralization, but also more importantly is how secure and safe, how much on-chain that you can actually manage all the risks. Because if we're building an infrastructure, you want it to be built on solid rock rather than sand. Others who build on top of us can choose a different trade-off, optimize for, return or risk or whatever it is. But as for infrastructure, like Acala, we kind of had to opt for a very safe mechanism. But we can go into all of those discussions, and feel free to pop your questions in the ask a question box. It can be related to, certainly can be related to Acala, Aosd, or other products that we built. But also feel free to pop in any questions that you had. I know last week was a very dramatic and also I think it can probably be termed as black swan event for the crypto world, and many people are affected. So if you do have other questions related, then also feel free ask the question, and we'll try our best to actually address those concerns. Yeah, so let's go ahead.
Cool. Yeah, so like Bette said, this is meant to be, partially us taking you through some slides, but definitely use the ask a question section at the bottom if you want to ask any questions, and we'll try to keep an eye on that as we go through, and we'll definitely spend some time at the end to just go through everyone's questions that you might have. I'm going to start out sharing some slides. Cool. So let's get into it. The agenda for the day is to go through initially the different types of stablecoins, how they work, what are the different kind of attributes and trade-offs between the three main categories of stablecoins, as Bette mentioned. And then what is Aosd and how exactly does Aosd work? And of course, we'll leave time for questions at the end. First, let's just go back to the most basic of all, which is what is a stablecoin to begin with. As you probably all know, a stablecoin is a digital currency that's meant to maintain the value of a specific reserve asset. This is most commonly the US dollar, of course, which is because the US dollar is kind of the global reserve currency that most countries either use or reference when pricing things. Stablecoins also kind of allow people to, in crypto at least, to reduce the volatility of what they're holding. Some people, depending on the time of the market and what they actually do within the market, like to hold a certain percentage of their portfolio in stablecoins for the stability, of course. And then one thing also just to keep in mind is that stablecoins recently, over the past like maybe 6 to 12 months, have really started to emerge as kind of the initial killer use case or killer app of crypto. So a lot of applications and a lot of teams building around stablecoins. And Bette and I sitting here right now are an example of that. We're building this blockchain on Polkadot, all built around AUSD as a stablecoin. Someone also asked me today, actually, if they're talking to, let's say, their family at the dinner table, they're not crypto people, and they're wondering, why should I even use stablecoins and what can stablecoins be used for? One thing, especially now with inflation going on, is going down to the third bullet point here, is just access to this new financial system. Right now, banks are offering a range, sometimes around 0.5%, maybe 1% at best. And we're sitting at 8%, 9%, potentially more in inflation. So you're actually losing money by holding dollars in a bank account. The other thing is just for people in certain parts of the world, they may not have access to the same financial system that others do in maybe places like Europe or North America and parts of Asia. But this also, stablecoins and crypto in general, of course, allow people access to this new financial system that's being built. And with that comes other opportunities to earn yield and kind of improve their financial situation. And then the other, for just general individuals and also institutions, why are big businesses interested in stablecoins? It's because of the speed and the reduced cost and friction of sending money to anyone around the world. I can send money from here to Bette in Australia in probably 10 seconds using crypto, and it would take me probably 2 or 3 weeks to send $100 to Australia through my banking system. So
there's one more. There's one more then.
Go ahead.
There's one more that's probably more specific to the sort of the lending over collateralization type of stablecoin that MakerDAO and also Acala is building, is folks who's holding say ETH for Maker, but like DOT for Acala, and they're long their crypto assets, and they don't want to exit their crypto asset position, but they still want to draw liquidity for any of those reasons that Dan mentioned, and they use a mechanism of collateralizing their crypto assets and then draw liquidity out of it in the form of DAI, and of course in the Acala's cases in AUSD, and then be able to spend it or put it in other assets or doing whatever they need to do there. So we can go into a bit more detail how that happened, and then what you need to be aware if using this kind of system, and then how does it compare, right? But I will just say that much now.
Yep. Yeah, so we'll get more into detail about what Bette means by drawing liquidity out of your assets. So this is also really important, especially with everything that happened in the past couple of weeks in crypto. So these are the three kind of main stablecoin categories that you can just kind of mentally picture when you think about stablecoins going forward. One thing that I kind of noticed over the last week or two is that a lot of people, I think, considered all stablecoins created equal, and this couldn't be further from the truth. There's these three categories we'll go through in the next few slides as far as the kind of attributes and differences, but I'll go through these here right now quickly, and then expand on these in a second. So first, in the upper left, number one is collateralized or over collateralized often, and crypto-backed stablecoins. So these are stablecoins that when they're issued, they're backed by real crypto assets that are most of the time decentralized, so not necessarily tied to fiat money in the real world. Number two is algorithmic stablecoins. These are not collateralized, so they're actually not backed by anything, and rely often on kind of creative or experimental kind of algorithms to maintain the price of $1. And then the third category is fiat backed. So these are examples like USDC or USDT that are backed by a dollar, a real US dollar in a bank account somewhere for every one stablecoin that's issued into the market. So these are inherently not decentralized. These are backed by centralized assets and run by entities like Circle in USDC's case.
Yeah, I think the point we want to make here is like there's no perfect like stable coin. There's also no like silver bullet for how and what you should choose to use. This is more to do with like if you are using any of this stable coin, you need to know what's behind it, right? For example, if you're holding USDT, you need to know it's not just cash, right? A portion of it you're holding essentially a basket of assets of cash, and also maybe some treasury bonds and maybe other type of assets in the real world. And this is your one USDT represents, right? And this is important. And then if you're holding DAI or AUSD, you should also understand that there's a basket of ETH or DOT or other assets, always more than the dollar value that you're holding. And then if you're holding algorithmic, then you need to understand when you're actually minting the token or burning the token, what should happen, what happens to it, so that when you actually kind of like decide to use it, what risk you should be aware of, and then what advantage you can take from each one of them. I think they actually play a different role for different purposes and different users, and also have to compromise for trade-offs, right? I think stablecoin is like blockchain. There's also this trilemma of optimizing for certain utility, right? So whether it's like optimized for liquidity or optimized for decentralization, censorship resistant, or optimized for capital efficiency, those are trade-offs. You may not get all of them all at the same time, but it's important to be aware what you are trading off. Yeah.
So first, let's go into over-collateralization, and I want to give kind of a silly example, but it's a real-world example just to show you kind of what over-collateralization means when we're talking about stablecoins. So in this example, just imagine you want to take out a loan to buy a car. You already have 15,000 saved up, but you want to take out a loan of 5,000 to buy that $20,000 car. And so you go to this bank called Safe Bank, and they have a requirement that you need to give them 2 times as much money in collateral or a down payment as you want to take out as a loan. So that collateral down payment, you don't have it. So you talk to your rich uncle and you get $10,000 from him to give the bank in order to take out $5,000 for that down payment. So you get the $5,000, you buy the car, and then over time you pay your uncle back that $5,000 and he pays the bank. So that $10,000 is returned back to your uncle, his original down payment, once that $5,000 loan is repaid to the bank. This, of course, would never happen in the real world because no one would ever give the bank more money than they want to pull out. But this is an example to kind of illustrate how over-collateralized stablecoins work. The point is that giving the bank, in this case, more money than you need. The bottom here, I explain, this ensures that the bank knows their $5,000 loan that they gave you is safe, even if you run away, you flee the country, or you don't repay the loan, because they have more money than you took out, so they can cover their losses if you were to run away. Otherwise, they just wait on you to repay the loan and everything is good. We may, throughout this presentation, refer to solvency, and I just wanted to call that out. The bank in this case wants to remain solvent, meaning they have more assets than they have issued debt. The same thing kind of applies to these crypto systems or protocols. You want to always make sure that you have more assets or equal assets to the amount of debt you have in the market. Otherwise, you become insolvent, and that's where kind of things start to unravel. You have something to add, Betty?
And then this would never, in the real world, you don't do that mostly because you rely on trusted entity. And then on the blockchain world, you're self-solvent, right? So that's why you have this mechanism to guarantee there's no bank run. You can always cover what you've borrowed.
Yep. So getting into the details on how collateralized or over collateralized stablecoins work. So As far as the issuing entity, there is no entity. That's kind of the whole point. It's a decentralized system, often referred to as a protocol. These protocols are all on chain, meaning every transaction, everything involved, even the code is fully transparent. And these protocols or these stable coins are often governed by token holders. And in Acala's case, ACA is the token that's used for governance of the network. And then how do you generate AUSD, or in general, any over collateralized stablecoin? At its most basic level, you need collateral. So whatever the system is accepting as collateral, and you can acquire that collateral wherever it may be. In this case, let's use DOT as the example. You then take your DOT to Acala, and you lock that up essentially in a vault, basically giving the Acala protocol your DOT as a down payment or a collateral, ensuring that there's backing behind whatever AUSD you issue to yourself. So third, the AUSD is issued, and then you can run off and do whatever you want with your AUSD. But in the end, you do need to come back and eventually pay that AUSD position off back to the protocol. So to pay the loan off, you come back, simply bring your AUSD, pay the loan back. Right now the interest rate is 3%, so you kind of owe that back to the protocol. And then when this is finished, your DOT is kind of free, so you can remove that from the vault and then do whatever you want with your DOT. It is important to call out trade-offs for each of these. Bette already mentioned that every stablecoin kind of has its trade-offs. So in this case, one of the trade-offs would be capital efficiency. So of course, it does require more collateral than you are able to issue in the stablecoin, but these collateral ratios can fluctuate. So we will say that at this point, Acala just recently launched AUSD probably 2 months ago or so. So we're still working with, so we're still keeping our collateral ratio relatively high, but we're working with a company, kind of a firm that does risk assessment called Gauntlet. They've worked with a lot of the top protocols in crypto like Aave and Compound and others. And they're helping us assess the risk of our stablecoin and set these metrics like collateral requirements. So this collateral ratio over time could be altered and lowered slightly.
Yeah, so I'll just answer 2 questions that people just asked in the ask a question box relevant. So one is related to Tether, so USDT. The other is related to UST. So as mentioned, there are 3 categories, right? So if we recap, there's fiat backed, which is USDT, USDC. So those are similar type of fiat backed stablecoin. And then the second category is over collateralized stablecoin, and that's MakerDAO on Ethereum, and then that's AUSD on Acala, native to Polkadot. So for the question there, then AUSD is at the same camp as DAI, but of course is native multi-chain on Polkadot. And then there's third category is algorithmic, and that's where folks asking UST, Terra stablecoin, and it's not the only one there. If you actually look back in history or even currently still going, there are various versions of algorithmic stablecoin. So that's the third camp there, backed by, I guess, most fundamentally automatically adjusting supply and demand, which I think Dan will probably go into a little bit later. So those are actually 3 different type of stablecoin, and then we fall into the category of MakerDAO's DAI category of over collateralized stablecoin. Yeah, there are also under collateralized stablecoin. They probably fall more into the camp of in between algorithmic and over collateralized stablecoin. Yeah, so yeah.
Cool. I'll go back into this. So that's so yeah, and I guess so. You already answered the one person's question about UST, and I'll just kind of expand on that question because they were asking about, I guess, avoiding what happened to UST. So this slide is meant to explain kind of part of that and how the $1 peg is maintained with over collateralized stablecoins. So in this case, it's a couple things. So first of all, Bette, do you want to get into, I guess, a quick note around over collateralized stablecoins, and then some, I guess, misconceptions around price peg versus $1. So sometimes it may go below, sometimes it may go above based on supply and demand. But can you just kind of explain that a little bit more?
Yeah, definitely. So for algorithmic stablecoin, peg is certainly very critical, right? If you go off peg, you can, especially like below market, $1, then you could go into this panic mode for everybody to withdraw, and that certainly accelerates the algorithm to go the other way compared to when you wind up the issuance, right? So that's the big unwind for danger for most algorithmic stable coins. So that's why I think throughout the last few days, it prompted many people to singly only focus on the peg. And I saw even relatively funny ripple effect into other stablecoin. For example, folks really got panic, and they're like, "Whoa, would Tether also be kind of like what's backed Tether USDT may also be very risky. What about ETH? What about Bitcoin?" So there's this panic moment of kind of like withdrawing everything from crypto, right? So then you see USDT like fell from the issuance because people are like kind of like cashing out. So that's why it's important not only just look at which category they are, but also look at what's behind it. Like USDC and USDT are both in a category of fiat backed crypto, but each one of them are backed by different type of real world assets. So USDT is backed by cash and also some other non-cash assets, right? So if you know that, then you understand, if people withdraw to what level, then they might get into a little bit of liquidity problem, right? But there are billions of dollars get cashed out, like redeemed from Tether, and then there's a momentary off peg, and then they come back, right? Because people realize, oh, if I withdraw dollars out, it actually works. Then they kind of come back to normal. So an off peg shouldn't be the single judgmental value, because the peg is mainly kind of a measurement of how much supply and demand of this particular asset. This is true for stablecoin. It's also true for like the fiat US dollar, right? You might think it's pegged to the CPI or the purchasing power, and it does go off peg, right? When you start printing money, it does go off peg. When there's more supply than demand, it does go off peg, and that's like inflation that you use a different term in a different world. And then in the crypto stablecoin world, if there's more supply, then certainly you may go off peg. And then if there's more demand, and then you can go into a premium. So that shouldn't be a single value to judge. Like for example, like in the last few days, for Acala, in the Polkadot and Kusama world, there's a dramatic price volatility, right? It's almost equivalent to the Black Thursday that happened to Ethereum, where the ETH value dropped dramatically, that caused chaos and also insolvency, to Maker and many other protocols, and just in trouble, right? So we experienced a similar market condition, but and in that case, your liquidity actually shrinks, and then AUSD actually gone into premium for a little bit, right? It's actually above $1. That also doesn't mean it's good, because a stablecoin is supposed to be, it's kind of in a range of the dollar. And then it quickly come back down once there's more liquidity in the market, and now it's like kind of like tracking in a certain level. So the moral here is like when you actually understand what's behind each different type of stablecoin, you then understand what risk associated with it, and then you understand when it falls below $1, what does it mean? When it goes above $1, what does it also mean, right? And so then you actually, well, I mean, if those are clear to people, then they are free and may well be all legitimate to actually choose different type of stablecoin to use for their purposes. But obviously for Acala, we chose Maker's model mostly because it's most secure on chain. As you saw, the silly example that Dan gave is like, even there's a bank run, we have enough collateral to actually pay back the debt. and then making sure that the system is whole, and we don't have to rely on I guess external, whether it's legal recourse or some sort of like a Fed intervention there to kind of like manage the system. That was mostly that consideration, so that it can be native Web3, and also push to decentralization to as much as possible, right? Because if you use fiat-backed stablecoin, there's also a systematic risk where if they are regulated or if there's a ban on the institution behind, say, USDT or USDC, then essentially your coins will probably cannot be redeemed, right? And could also be censorship for certain addresses, so your asset could be confiscated, right? So those are the stuff that if you understand, then you know where your risk threshold is. It doesn't mean you will just avoid it completely, right? You can still hold USDC knowing what are the risks. And that's the point where you may think diversify to other type of stablecoin or other type of asset. So, if one black swan event happen, you may not be completely screwed, right? So this is kind of like things to consider, I guess.
Yep, and we also had someone in the Q&A, Chesco, asked, aren't these essentially the same mechanisms to achieve PEG that UST and Luna employed? So I'll explain this, and Bette, you can add if you want to. So one thing here is that DAI, first of all, DAI has been in existence and kind of proven on Ethereum for at least 5 years, so keep that in mind. And AUSD is essentially, at its most basic explanation, is a multi-chain or multi-chain up to hundreds of blockchains version of DAI. In AUSD's case, we do use supply and demand to help bring the price as close to 1 as possible. And there's multiple kind of levers that can be pulled to achieve this. One is through the interest rate. So this is the most important part of this section. There's an interest rate that I mentioned earlier, around 3%, to that people are required to pay when opening up one of these positions. If the price is less than $1, that means there's not enough demand for the stablecoin. So how do you increase demand? You can decrease the supply of AUSD. And you decrease the supply by increasing the amount of the interest rate for minting that stablecoin. The difference between this and Luna is that they were using supply and demand, but there was no interest rate. It was purely based on minting and burning Luna and UST. There also was arbitrage. So people, of course, were arbitraging because anything can be arbitraged across different exchanges. If the price is less than $1, you would buy low and sell high, and then the opposite if the price was above $1. But the biggest difference between DAI and algorithmic stablecoins is here. There's actual crypto backing the stablecoin. There's actual crypto that can be liquidated and sold in order to maintain the solvency of the stablecoin protocol. In algorithmic stablecoins cases, there's no backing. There's nothing actually backing the stablecoin. So if the arbitraging and if the minting and burning of these tokens doesn't work, then you go into this kind of death spiral.
Yeah, and then algorithmic stablecoin usually manipulate supply and demand of the backing token, right? So if the price goes down, you actually print more of this correlated. There's usually dual token model for algorithmic. And then one is the stablecoin, and one is the other token that trying to manipulate supply and demand to actually keep the peg, right? So when it goes up, then that's fine. But then when it goes down, you usually print much faster of the behind the scene token, like Luna token or whatever other algorithmic stablecoin token. And that's, you print much faster, like in a set. So you go into this inflation mode in order to keep the peg. And then, of course, if this reflexive cycle goes on, then the hyperinflation becomes hyperinflation, right? And then it's just like, there's nothing in defense for that because you have no collateralization. And then very clear distinction is for either fiat or the over-collateralized stablecoin is, sure, collaterals will go down dramatic in value. But for over-collateralized stablecoin, when it get to a certain level, usually way above 100%, usually way above the $1 peg, the collateral will get sold off and then pay back the debt, and the system, will be solvent. So there's always a stop, right? So without collateral, you can go all the way to the bottom, but with collateral, especially over-collateralized stablecoin, you're always above water quite a bit. And then for Acala, we only just get started. So you can see the risk parameters are really conservative. So it's usually like 200% ratio. And it may not seem, relatively attractive when you are more risk, you want to take more risk. But then I think it's proven very valuable for a very early protocol to have relatively conservative ratio, because we've been through multiple ups and downs within the Polkadot and Kusama ecosystem. And then last week was the cross-board black swan event, and just like a cliff drop. And I think the high collateralization ratio and the liquidation requirement actually kept everybody like above water, right? So this is the fundamental difference between if you have anything, backing of your dollar value and keeping yourself above water, or you're purely manipulating a token supply demand, and if that token is just, and usually that token is a single point of your success or failure, then that's certainly very fragile, right? That's probably also why so far most algorithmic stablecoin, if not all, haven't been very much proven, right? So, but it doesn't mean, it's the end of all of this innovation, because folks always try to figure out new mechanism and new ways to innovate. But it goes to say, if you actually understand what is the holding basket when things like go the other way, then you will understand the risk, right? So, so that's the difference.
So I'll go through this one quickly. So this is just the same type of categories that we just went through on the over-collateralized stablecoins. In this case, algorithmic stablecoins also are typically run by protocols or decentralized systems, not companies. And in this case, you basically are using this minting and burning mechanism of burning $1 of a network token and issuing $1 of an algo stablecoin. But this is a very broad category, so different people over time have taken different approaches. Many of them have gone to zero. They're all very experimental. And as Bette said, the over-collateralized kind of DAI model is by far the most proven of these decentralized stablecoins. How the $1 peg is maintained, of course, this also varies. But this is the minting and burning mechanism, as well as arbitraging. The risk here, of course, is that with stablecoins that are built like this, there's no collateral actually backing the stablecoin. So when the previously mentioned mechanisms don't work, typically these stablecoins will dramatically fall in price and go to zero. The trade-offs here, of course, no collateral backing, experimental, unproven. But as Bette said, over time, we're still super early in crypto's history. There will be more and more models of this tried and tested over time. It's just important that everyone knows that all stablecoins are not created equal, and people are going to be building in different categories with different levels of backing of each.
And also someone asked, our partnership with UST. So like we didn't partner with Terra, we partnered with Anchor. Was mostly to have Anchor deploy within Polkadot. And then the reason mainly being we actually offer this really high quality staking derivative called L-Dot, and also LKSM on the Kusama side. It's non-custodial, using XAM trustless for staking. And then, we've also got really good liquidity for both LKSM and also now L-Dot as well. We've got like 4 million staked on the chain. And at the same time, the product is designed quite easy to use, because you can simply just hold the L-Dot and LKSM token, and then you can already expose for the staking return from the chain. And another factor is we may not be most, I guess, aggressive teams in the market, but we mostly focus on how to improve our security and also making our products, at least more closer to institution grade of offering. So we have Blockdaemon and also Coinbase Cloud joined as a validator, like institution grade validator with their service level. And on top of that, they also provide slash coverage for the assets that stake through their validators, right? So and then our goal is not like being the one product rule at all, but it's more of like, with the tech that we have, how much more can we democratize, right? So in this case, we basically democratize some whale type of staking service only enjoyed by whales if you have large sum of DOT or KSM, and then you can have really good low commission, slash coverage. Can we do that for everybody? So that's essentially the sort of the stance of the LDOT and LKSM. So in a way, I guess we democratizes those service, having the high level of service level sort of validator joined, but there's also community validators as part of that group. Commission kept at very low level, dedicated validators, and also some slash coverage, which usually only whales enjoy. So those are the sort of the stuff that makes that product stands out. And then Anchor is not the only one there really desire this product to be integrated. So this is a very good collateral, I guess, for any type of money market. And then Anchor make the move and want to do that and deploy on Polkadot and then use that collateral. So that was the partnership there, and then not specific to Terra. And then potentially, like if this event didn't happen, we'll probably go as far as creating a stablecoin pair. But other than that, there hasn't been other stuff going on. So if you're asking what's the status of that partnership, that really depends on where Anchor is at. Anchor is a money market, right? So and of course they are kind of very much dependent on UST. So so I'm not sure where they are at. But this goes to say there are other money markets that desire LDOT and LKSM, and so we're continuing kind of like working with them for this type of integration. So I hope that kind of clear things out.
Cool. Third category, fiat-backed stablecoins. Let's use USDC as an example. So in this case, unlike over-collateralized or algorithmic stablecoins that are typically decentralized or mostly decentralized, fiat-backed stablecoins are operated by companies. So in this case, USDC was created by Coinbase and Circle, and then Circle is behind this other kind of bigger consortium that works on stablecoins called Center. How is USDC produced? So if you or me goes to, let's say, an exchange and gets USDC, that's one method. You just get it. But how did that USDC actually get to that exchange? Who made that happen, and where did that come from? That's where you actually need to go to Circle and complete KYC and onboard onto Circle's platform. Then you link bank accounts to Circle's platform and issue a transfer. In this case, probably from a bank to maybe a wallet on, let's say, Binance, for example. So that fiat dollars from the bank get converted into USDC and transferred to any USDC address in the world. The USDC, how is a fiat-backed stablecoin backed? It's backed by dollars in a bank account that are regulated by, in this case, US financial institutions, and audited by several different accounting firms to make sure that it's true that if there's 100 USDC in the market, there's $100 US in the bank account. And then how do you go back? So if you do have an account with Circle, people can actually go the other way. They can take their USDC back to Circle and actually redeem that back into US dollars. So this is how fiat-backed stablecoins work. There's, of course, varying details when you really look under the hood as far as like, is it all US dollars? Is it dollars and bonds? There's different kind of mixes. but this is just the high level of how these fiat-backed stablecoins work. The trade-offs are definitely something to not look past. So if there's plenty of us that are in crypto because maybe you value decentralization and kind of owning your own assets and having being a part of this financial system that's not tied to any institutions or governments or people who can censor transactions. In this case, every fiat-backed stablecoin is centralized, so they're operated by companies. There's definitely like these auditors and governments involved. So that's just one thing that people take into consideration when thinking about which type of stablecoins to use. Cool. So there's been a lot of questions that I think we're going to answer in these next few slides around the backing of AUSD, the different collaterals. So let's get into some of these, and I think it'll help answer some remaining questions people have. So first of all, you now have background on the three different types of stablecoins. So over collateralized, algorithmic, and fiat backed. AUSD is the product that Acala has been building for the last few years, and really building to serve as the native and kind of primary decentralized stablecoin of every blockchain or every parachain and every application built on both Polkadot and Kusama. So Polkadot and Kusama for now can both scale up to 100 blockchains on each, and this will continue to grow. So AUSD, like we mentioned, similar mechanism as DAI, which has been proven to work over the past 5+ years. But AUSD will be natively multi-chain, so it'll serve hundreds of blockchains in the very near future. So AUSD, as you all hopefully know, if you don't know number one, you definitely haven't been listening. So number one, decentralized stablecoin. AUSD is backed by crypto assets that we'll get into in a second. AUSD is also a liquidity generator. So Bette mentioned this earlier, and we'll explain in a second what that means. But basically being able to pull liquidity out of collateral assets without selling them or without losing ownership of them. And then number three, just because of the way Acala is built, AUSD also provides users as well as companies and applications and developers of those applications access to this whole world of fintech that's plugging in to the Acala ecosystem. So we've already been through a lot of these things. I guess let's see if there's anything that we haven't mentioned. So over collateralized, these are the different assets that are currently accepted as collaterals for minting AUSD, and this will continue
I will
to
add
grow.
a little bit of detail to that one. So
Yep.
Each collateral has its own risk parameters, and then they also have a cap on how much AUSD can be issued for this particular type of collateral. And then how did we come up with this number? So we work with Ganglet, who constantly, like real time, observing each asset. For example, they will observe on-chain data and also on the market data for DOT. Well, each type of those assets, what's their volatility, how much trading volume is available, and things like that, to come up with, okay, for DOT, this is the maximum amount of AUSD can be issued out of this type of collateral to be safe. So for example, out of all of these assets, there are essentially two types of assets. It's like DOT and then DOT derivatives, which are also kind of like DOT, but they just have a different liquidity level in the market. And there's also a native token like ACNKR. So we have been extremely conservative. So for ACNKR, they are considered volatile assets as well. And then they only capped at between 5 to 10% of the total issuance. I think for ACA, it's like maybe 6 or 7% of the total issuance. So majority of the AUSD issuance are come from DOT assets, like safe DOT derivatives, right? So like LDOT and LC dot and things like that. And of course, like when you're choosing these assets, it's quite important to understand the dynamics, right? The protocols are built on Polkadot security. So there's a certain level of certainty that, while DOT is going to be volatile, it's going to be there to provide overall security and the Web3 internet service for everyone built on top of it, like Acala. So that's one aspect. And then the second aspect is stepping outside of this Polkadot only asset class, is you can see many of the crypto assets are correlated. You can see when Bitcoin goes up, everybody goes up, and when Bitcoin goes down, everybody goes up. So it didn't used to be like that, but then crypto assets are now moving in the same direction, right? So then it actually have creates a risk for all assets when shrinking. Then you have a higher liquidation sort of risk for over collateralized stablecoin that rely only on those assets. So right now we are working with folks like Centrifuge and others to put in other type of tokenized assets, not pure crypto assets. They are real world assets that have a bit more stability in there in terms of pricing, and also very much not correlated with the crypto world. So when crypto world goes like does like big ups and downs, those assets are relatively boring and may have a little bit of fluctuation, probably like a flat line compared to what crypto world is like. So those are as a good way to kind of balance out the basket of assets for AUSD or DAI as well in that category. So so those are the considerations that we take. Yeah. Oh, and of course, people asking BTC and ETH. Yes. So those would also be in the category of crypto native assets. And yes, they will be considered as collaterals, but also subject to the similar risk parameters that we will need. For example, there are trustless BTC being bridged into Polkadot through Interlay. So that's another parachain, Interlay parachain for trustless BTC. And then for ETH, there is also trustless ETH, but also ETH may come from bridges, right? They have different risk profile, obviously, in terms of liquidity and also the way that they are bridged in. And those will all be used as factors to consider. One is how much issuance, like cap for AUSD, then BTC and ETH can generate, for different type of BTC and ETH can generate. And then also, what is the collateralization or liquidation ratio for them would also be different, right? So, yeah.
Cool. Next is Liquidity Generator. So just another thing that AUSD allows people to do. In this quick example, so this is just an example where someone's staking their DOT on Acala for liquid DOT. So this is the liquid staking product that allows you to stake DOT and then get this liquid token to then go use for anything you want. One of the use cases of LDOT after this is staked on Acala is to put this into an AUSD vault, lock this as your collateral, and then mint AUSD as a stablecoin. So what this does is it turns one DOT, which originally with just regular kind of the traditional DOT staking is just locked away doing nothing. With LDOT and AUSD, you can essentially turn one DOT into 2.5 dots that are kind of circulating and kind of igniting the economy on Polkadot. And then third, it looks complicated. It's not that complicated, but this is the Acala blockchain here with our DEX and liquid staking built in that kind of support AUSD. And then our EVM plus environment that combines Ethereum or EVM plus Substrate. And on top of that, we're about to have a lot of dApps begin to launch, which all will be, pretty much all of them will be integrating with AUSD. What this allows is for Current.com and many of our upcoming fintech companies to basically plug into the APR or the yield that's being generated from these various dApps. So these could be LP positions, these could be lending and borrowing on money markets, but those yields will be going up into the fintech world. So if you're a DeFi developer and looking to build with us, or maybe one of the teams that's already building with us, this is definitely a big customer group that's coming to any of the applications building on Acala. Comment, Bette?
Yeah, I think we can address some of the liquidation questions folks have. If you have some illustrations, I can start talking about how liquidation happen and how to keep.
Let me go through. There's a couple more slides that I think will address a lot of these questions, and then we can go into those. So first, so how is AUSD generated? We've been through this, but this is just a visual to show you. So option number one is locking assets up as collateral and issuing yourself AUSD. So this is various types of collaterals. In this example, it's DOT. In this example, it's KSM. And they're generating 50K of AUSD with 100K of DOT. This can then go on and be used for payments or transfers, trading, earning yield on the stable coins, using in dApps, even purchasing items in marketplaces like Efinity, and many other things that are about to go live in the coming weeks and months. This is a slide that I think answers a lot of the questions that have been posed in the chat here. So what are the various collaterals that you can use to mint AUSD? So here are some examples of current collateral. So DOT, LDOT is the liquid staking collateral, ACA and KAR from Karura and Acala, as well as KSM and LKSM, which is the liquid staking version of KSM. This is basically showing you that these are various collaterals that are being used to issue AUSD. So it's spreading AUSD's kind of vaults across multiple different types of assets. One thing that does is it ensures that fluctuation in one asset doesn't necessarily impact the overall stability of the stablecoin. So someone asked, like, what if DOT drops 99%? Well, that would trigger a lot of liquidations on the DOT side, but the other tokens, ACA, KSM, for example, these would all not be directly correlated with that one asset. So it would help to maintain the overall health of the stablecoin because it's backed by multiple assets. The other thing is that by having multiple assets as collaterals, and we're going to be expanding this collateral set over time. So we'll be bringing in BTC, we'll be bringing in ETH, and potentially other potentially other parachain assets as collaterals. This also ensures that AUSD can continue to grow because you need access to a big collateral set in order to be able to mint more stablecoins from that. And then just to be clear, we're talking about opening up these vaults and then generating AUSD from that. That's one way of getting AUSD, but there's a couple other ways that you can get AUSD. One that's very obvious is just getting AUSD on a market. This could be on a centralized or decentralized market where you simply just acquire it with something else. So definitely don't need to collateralize assets in order to get AUSD. And then the third thing going on are liquidity rewards. We have Acala hackathons going on right now where there's AUSD being given out as prizes. So there's other ways to earn AUSD as well if you don't want to open up a vault. So this is just, we'll end with this and then we'll start going through questions. And I think Bette, you wanted to go through some liquidation details. This is just meant to show what the ecosystem is about to look like with AUSD integrations coming across Polkadot and Kusama. So AUSD integrations into all these dApps, onto parachains. But what does that look like when an AUSD is on 100 parachains? This is kind of a visual to show you what 100 parachains look like. And then across Polkadot and Kusama, 200 parachains will be live in the next couple of years. So a lot of growth coming for AUSD and the Acala and AUSD ecosystem in general. And yeah, thanks for everyone's attention. We'll start going through, we've got a lot of backup slides also to explain more about liquidations and other things. So Bette, let me know where you want to go from here.
Yeah, I want to address a few questions regarding what happened when liquidation happened, right? So let's take an example. It's like DOT. If you put let's say 100 DOT into the vault, yeah, in your case, and then it's 2x requirement, right? So let's say those DOT actually worth $2,000, and then you can only borrow 1,000 AUSD, like generate 1,000 AUSD out, right? So this is the current condition, and then liquidation is triggered. So the liquidation. So this is the collateralization ratio, right? It's 200%, and then liquidation ratio is slightly lower than that. This is an innovation of Acala because if you put them at the same level, you can already predict what is going to happen if market shift a little bit and then you get liquidated, right? If you put in just at the collateralization ratio, if the market is moved slightly below, then you're doomed, right? So we have a cushion. So we have a slight gap between collateralization and liquidation. So let's say you put in $2,000 worth of DOT at the collateralization level. The liquidation ratio could be 150%. So when DOT dropped to $5, then you get liquidated, right? So there's a price for the liquidation price. So there's a little bit of gap there. And then what happened when the price did drop to the liquidation price level is this gap. So this liquidation price is still above 100%, right? So you still have $1,500 worth of DOT in this vault, and then supporting $100 worth of AUSD. So you're always above the water. This is what I mean by above the water, right? The water line is at 1-to-1. So 100. So the water is at exactly the same amount of DOT backing AUSD. So the system that we have, so-called over collateralization, it means there's always more collateral in the system than the AUSD out there. So supposedly. And then when the liquidation happens is when the price drops to the liquidation price level. Let's say it's $5 of DOT, right? You started with $10 DOT, and then it's like dropped to $5 DOT, and then you get liquidated. And then you get liquidated actually at a price level that's above $1, right? Above 1-to-1. So when you're liquidated, the system is trying to sell off the DOT as efficient as possible. So it will actually go onto the DEX. And then if there's a big slippage on the DEX, then they will try the auction. The auction is more, I guess, a slow and calm way for people to bid for the collateral in a sensible manner. And then if you can recoup those values out of the DOT, then you recoup means you actually sell the collateral for AUSD, right? And then the AUSD that you sold plus a liquidation penalty, which is a disincentive for people not guarding or not securing their vault, right? So those all add together. You liquidate your collateral for those amount of AUSD. So you borrow 1,000, right? So then you recoup $1,000 plus 15% of penalty, and then those get paid back to the system. And then when I say payback, that means that amount of AUSD is degenerated, right? So you no longer have AUSD outstanding that can be used in the market. And of course, your collateral is sold off, and then you pay back the money that you actually generated. And then if there's any leftover collaterals, it gets returned to the vault owner, and then it can start fresh again. So usually, well, not usually, it's like always, people should avoid liquidation if they can, right? Because liquidation is a danger obvious to the vault owner. You may, and you obviously will have a loss because of the penalty you pay. And also if the market drop very sharply and you're selling off your collateral, then you may not get a good price for your collateral. So it's better you do it before this chaos happen, right? A number of things, like one is you could actually somehow acquire AUSD and then pay back the loan. And then two is you could also get more collateral so that your liquidation price is even lower than the previous liquidation price. So you can actually, I guess, have more room to kind of manage your vault. So there's different ways that you can actually keep it safe, but the goal is like avoid liquidation, right? So that's.
And
I hope that actually answers that question.
One thing to add, Betty, is that the word liquidation, I think, scares a lot of people, and in some cases, liquidations mean different things. In this case, liquidations is only being done on however far your collateral has fallen below what you owe back to the protocol. It does not mean that your entire collateral set is just wiped out and sold for zero. Like it's not a full liquidation. All it is a penalty up to the certain point that you kind of owe back to the system, plus a 15% liquidation fee, which is just a penalty to kind of incentivize people to make sure they're managing their vaults.
Yeah, and then so it's worth pointing out, like in Black Thursday, right? So Is dropped 90%. of the value. This happened like very sharply. And then you could imagine if you sell your asset at this market, it could get very low price. So, if you're not managing your vault really well, then you could add a total loss. But also at the same time, it poses a systematic risk to like maker at the time, because there's multiple things happen again. A black swan event usually is like multiple things that went wrong all at the same time. So the Oracle didn't work because the network's congested. And then liquidation also didn't happen normally because it's also a server bot run off-chain, and then they couldn't compete the gas price. So this Is actually sold at $1, right? That actually was one of the main reasons why it became insolvent, right? So it kind of accrued a huge amount of debt that you couldn't quite pay back straight away. So it's okay for over-collateralized protocol like Maker, Compound, Aave, of course, Acala, AUSD included, to have some level of debt in the protocol. That's okay. You can see out of this liquidation event, everybody has some level of debt on the protocol, bad debt on the protocol. But if it's not overwhelming, that's usually fine. But that for the Black Thursday, they actually have like overwhelming bad debt that there's no way that can be recouped in a short period of time, and that's when they call kind of like a shutdown and then have to redo the kind of like vitalize the system by injecting USDC into it as liquidity, and also kind of like auction off some of the KAR token they have to kind of make the system whole again, right? So I'm telling all of you this is not to like kind of like bash Maker, because we have to be very respectful. Like I have a lot of respect for teams coming before us. If you have folks who are building remotely similar products, and they went through ups and downs, this is the time to actually learn from each other. Especially we have open source community. We know the Compound guys really well, understanding how they manage their risks. And then at the same time, this is what we are doing right now as well, is like after Black Thursday, we've implemented on-chain risk management mechanism, like our keepers, like the monitoring system that figure out whether any position is at risk and kicks off liquidation. Those are on-chain, so it's not affected by any like gas fees or any off-chain conditions. And our Oracle has a quality of service, so you always kind of those transactions are prioritized on chain, and many more, right? To actually safeguard the system. So we still wouldn't say this is like a perfect solution just yet, because yeah, sure, the last week was bad, and it's probably the worst of all that we've experienced. But who knows what the next one will be like, right? So we've done some simulations. Like last few days, the collaterals actually dropped 90% from all-time high from the DOT and KSM sort of family. That's expected. It's volatile, right? Assets, and the system can sustain it, and it can also drop another 90%. It can also sustain it. But the thing is, like this thing is like you could have like a worst case scenario and then figure out whether it will work or not. But nothing actually beats a real life stress test like what we just been through, right? So this is a time to actually kind of, that's why we are sharing all of this. It's like, yes, you could stand there and point fingers like who's the bad guy, who's the villain. But the thing is, everybody contribute to where we are today. Can you say there's no greed in anyone who participated? Can you say, there's not enough has been done, or there's not enough voice been heard, or not enough transparency there? Everybody actually contributed. But I think at the very least, builders as well as participants, we can be a little bit more self-responsible, right? And in the crypto world, like a lot of us are self-regulating. And then as for individual participant, we should also take on self-responsibility to understand if you're putting your assets into a place, there's at least two things you need to think of. It's like the place you put into is an easy way for you to exit, right? If you put in, say, assets onto a new chain, can you redeem it? If you put it in a parachain or any blockchain, if you can't redeem it back, there's a big question mark there. And can you actually suck up that loss if anything happened to the chain? That's one. And then number two is when you redeem, you also think one step further. It's like if 50% of everybody like you redeem the asset, what is going to happen to that protocol, right? If you can kind of like answer those two questions, and you also can adapt to the losses that those, if it didn't happen the perfect way, right? The worst case scenario, and that's also okay. Then this you might, this is very well for everyone's free choice to experiment with what they want. But I think we can probably do more on asking those questions, and also for builders to be explicit about all of these parameters there. And that's why we're also doing this sort of stuff. And everything is like open source, so you can always check the code on chain, as well as coming in this form of discussion as well. So yeah, hopefully that helps.
Cool. Yeah, I think we've definitely gone through a lot, and we've been answering questions throughout. Let's see if there's any other questions that we may not have covered, but we're getting probably to the point of wrapping up soon.
Let's just quickly go through the questions. I think number one is quite obvious, right? So Acala, we built native multi-chain stablecoin, and then liquid staking and also DEX are mostly supporting the risk management and also liquidity for the protocol. And then that's why we actually integrating with almost all parachains. There are 20 parachains that we connected to on the Karura side. If you see the map, right, there's like a huge hub with many chains that are connected. And then there's a dozen more to come. And then that happened in the last 10 months. And then for Acala, it probably will happen a lot quicker because everybody is tested with us. So yeah, we play a different role supplying this sort of the credit system or the stablecoin system for the Polkadot world. And number two, is it possible to have minted AUSD that is 100% secure? Yeah, nothing is 100% secure. if you, like as I explained, if you went through a liquidation, then there will be losses. And then also regarding for ACA massive drop, which already happened, right? But ACA is only constitute 5 to 7%, if I remember it correctly, of the total issuance allowance. So that's like a small percentage. And then two things to consider for collateral, like what is the probability of it going to zero? And is DOT and ACA can go to zero? I think there's a probability, right? Anything can go to, including Bitcoin, right? Until it's proven wrong. But at the same time, you have to judge the probability of that, and that's why we're very careful of considering adding other collaterals at this point, right? There are money markets natively that will be built on Acala. I think money markets can take on slightly more risky, like parachain assets in the lending protocol to borrow AUSD and other stablecoins. But as for stablecoin itself, that is usually that's the highest grade of risk assessment. We have some partnership with Kujira. Yes, so Kujira is actually a generic protocol that helps protocol to manage their liquidation in a democratized way. So essentially everybody with a UI, you don't need to run a bot, you can participate in liquidation, because then you pick up cheaper collaterals. You also helping the system to return to a better risk level. So it's like win-win, right? But their participation will open up more room for everybody to participate. So they are deploying on Acala and Karura, and I think they may also maybe run their own chain or something like that. But yeah, so they are certainly more versatile, because their product is not single-sided, depend on one thing or the other. They're providing a generic service. Regulation, that's a good point. So one thing I would say is I think there will be regulations for stablecoin and probably crypto world in general out of this. And the main thing there is, I think everybody has a responsibility, is categorization, because not every crypto, not every stablecoin created the same, right? So when regulators looks at this particular incident, it shouldn't just be like, let's ban all crypto or let's ban all DeFi. That is the wrong way going about it. But it actually takes everybody to actually explain and share those knowledge to say, oh, well, there are different categories of stablecoin, and they consist of this different type of risks. And if there's regulation or compliance, they should be specific to those different, specific to those risks, right? Because regulators come in a point of view protecting investors, right? And if they are having a blanket regulation for different type of risks, then one, is not effective. You're not protecting anybody. There's still loopholes. And then two, it's not helping an industry to grow. You're probably just killing off many of the innovation that trying to improve things, right? Because this is where we are, very early stage for developing crypto. So that is the thing. And then something more specific to Acala is the way that we build our protocol. We never say too much about this because we think it's probably a bit far off in terms of when we will practically be able to use it. Is our protocol has a way to open up for compliance and regulation. Like if there's, simply put, if there's KYC or AML required, we have a very easy way to technically to support this mechanism on our chain, just the way that we built it. And I think those type of products would come, and then we'll probably have an advantage of supporting those as well. And then there's a few things for staking. Yes, so for L.Dot, Acala, that I can stake my DOT and just leave it for a year or two. Or if I start now, I will have to withdraw and then deposit. Oh, okay. So for L.Dot, it is just normal Polkadot staking. So you can just stake your DOT via Acala and park it there, right? And a market like this, if you just park it there and do nothing, that's totally fine. And then there will also be stable swap for DOT and L.Dot and other DOT related assets. You can also participate in those, but they have a different risk profile. So so certainly you can just park it there by staking on Acala. There's no need to withdraw and doing anything. And the protocol also rotates. So if there's any validators suddenly increase their commission, they will actually be rotate out, right? So so you can just do that. And then, yes, there's different liquid staking DOT options. What are the differences and advantage? It's actually good to have different liquid staking protocols because you don't want to end up one pool have 50% of your DOT, right? I think anything below 10% is probably fine. So one thing, just like in general, I think it's good to have more liquid staking products. And then for Acala, you guys know where we stand, right? So we are certainly not optimizing for extremely high yield and doing risky stuff because the L.Dot that we produce is actually serving as a high quality collateral for stablecoin and then other sort of protocols. So that kind of determines the choices we make for the liquid staking that we make. So certainly build at a substrate level, right? So there's a certain level of risk being reduced compared to only building in EVM, because EVM is a virtual layer above substrate. So you still get into like gas wars, congestion of transactions, and other constraints of the EVM. You can still handle, I guess, to a certain degree, but at a substrate level, you're more versatile. So that's why we are building this way and thinking about it's going to support a USD, right? And then the second thing is, as I mentioned, because we are, so right now, someone asked also about this, like which fintech that we are partnering with. You know, it's current.com, but they're not the only one. So others we haven't announced. We usually get to a point where we're actually doing something substantially, then we announce them. So right now, current.com, they are running validators, also collators for Acala. So there's infrastructure. And then they also participating in staking. So that's at a product level from the partner, but we are also doing user level product integration. So making L.Dot available as a DeFi product because there's a yield element, right? But without a DeFi complexity, because you only need to hold it. So in that sense, there's a cascading requirement of how secure the protocol is, how stable it is. So on Karura, it's been running for 10 months, and it's continuously perform quite well. And then it's also consistently slightly above average for the yield, although we're not trying to optimize for yield very that much, because if you opt for very low commission validators, they may get slashed every now and then you are screwed, right? So that's also why in addition to just the community validators, we also added institution validators as a balance, so that the validator set is kind of not only balanced, but also increase the service level and security there. So that's sort of our stance. And at the same time, there's also protocols on our chain to aggregate all dot liquidity from all parachains. So that's Taiga and Tapio on Acala and Taiga on Karura. They can actually aggregate dot, L dot, other type of dot derivative on other parachains into this one synthetic dot asset, right? You can imagine if this all fragmented, it's very hard to do anything, and also increases the risk exposure if you have fragmented liquidity. So they are essentially doing a job on Acala to kind of aggregate this, which I think will help the overall dot ecosystem to progress. So yeah, so those are the reasons why I guess you can use Acala, but also there are other options there as well. And then when you choose a liquid staking product, do understand when you move assets onto a parachain, can you move it back? And then secondly, what's the redemption process like, right? Normally the redemption will follow Polkadot's redemption. Like on Acala, at least, if you do normal redemption, you will just wait for 28 days plus an error so that we can send the XCM message to Polkadot, and then it trustlessly return the asset. So there's 28 days plus a bit, maybe 29 days to be safe. You calculate that. So that is the redemption process. And then there's also instant redemption that you can, if there's someone minting at the same, or there's someone staking at the same time as you are unstaking, there could be a real-time swap there. So that it doesn't actually need to go to other chains. And it could also liquidate on pool when it becomes available. So understanding those is very important, because it's very easy and tempted just to put something. This is not just liquid staking. This is probably anything that you participate in. It's very tempted to just put your asset into a so-called vault, and then you're looking at 100 or 1,000% APY without knowing how to take it back. And the second thing is, what are those APYs, right? So in crypto world, anyone can mint tokens very easily. So if you're getting a whole bunch of tokens that are just minted out of thin air, it's totally fine. I'm not judging that. It's you just need to take that into consideration, right? So so those are the few things that you should think about. And of course, on the Acala side, there's one thing I want to emphasize. Maybe not everyone knows is we are conservative by attitude, which you can judge by our behaviors, but I guess fortunately, we also codified that conservatism on chain. So our ACA and KAR token economics is non-inflation. So we can't print, no one can print. There's no algorithm can print it. So it just stays at the fixed supply. So, and then the second thing is the AUSD is over-collateralized. You actually need more asset to actually generate a stable asset, with a smaller market cap. Right, so those add together makes us super conservative by code, and of course, then at the same time, you might think in this market is very good, but you also need to understand setting the right expectations. So we are not going to be those super, I guess, high project, growing to 1 billion overnight, because with this type of model, you really need real utility, right? And that's also why, even though we are being consistently being asked to just incentivize issuing AUSD, it's easy to do, right? If you issue $1, I just give you $1 for you to issue. That's very easy to do, but that is not sustainable, because you need real utility. So in our case, that's where the real growth comes from, is we integrate into the apps, integrate with parachains. There's a number of really good parachains coming up for different specialized DEXs, marketplaces, prediction markets, and also the Google for Polkadot, right, Origin Trail, and there are many different types that they all have a use case for decentralized stablecoin, like native, like AUSD, and that's where. And those, of course, is not going to happen overnight. Yeah, it's cross-chain. So those are the stuff that we are working on to actually grow real utility for AUSD, rather than just having this, I guess, utopia kind of growing the issuance on its own. This is also why it's important for everyone to know why we're doing a proposal for Treasury, DOT and KSM coming into Acala, and then being able to support AUS liquidity that actually deploy onto those parachains and dApps, rather than just staying on Acala. Because yeah, sure, we benefit from all the AUSD issuance, but if there's no utility and other parachains doesn't actually prosper as a result of it, then there's no kind of like trickle up effect for the whole Polkadot multi-chain ecosystem to grow, right? So yeah, maybe in the next session we can actually share a bit more on those treasury proposal, how one lot of DOT can benefit Acala, but more so is the multi-chain ecosystem brings everybody up, and then the multi-chain ecosystem can actually be bootstrapped. So yeah, I kind of gone off track quite a bit. Sorry about that. So.
I think we'll stop it there. We've answered, I think, most questions. The person Dot who just joined, I think you can go back and watch the recording, because we definitely answered the question that you asked about UST and Luna exchanges. AUSD was just listed on KuCoin. There will be many others coming for the stablecoin, and then everything else. Yeah, we've answered, I think, most of the questions now. And then somebody asked about the slides, so I'll send out the slide deck in an email following this, either tonight or tomorrow morning. So yeah, we'll post this on YouTube as well. Thanks everybody for taking the time to join. I think it looks like we had exactly 150 people join, and from all 6 continents. We had a lot of people from North America, Europe, Australia, New Zealand, South America, and a couple from Africa and Asia. So thanks everybody for joining. Have a good day or a good night, and we'll see you on the next one. Bye.
Thanks everyone.